Here we go. State of the market, March 24, 2016. We're going to be looking at the 2-day charts today so that we can include the news of the terrorist attacks in Brussels and see how they affected the market. So there's 4 main things you want to be looking at in these 2 days of the Dow Jones Index. This ETF is tradable, by the way. It's DIA. Alright, so on the 22nd, we had the terrorist attacks in Brussels. Now, you'd think, you're probably already familiar with this, and you'd think that a terrorist attack would hurt the market, much like 9/11. And look at this. They're trying to blame the people who are trying to crack down on terrorism for the terrorist attacks. Media's out of whack. But you'd expect the market to fall. In fact, we saw the market rise after those terrorist attacks. And then at the end of the day, things started to fall, and you could see a gap between yesterday and today. So we actually have, it looks like a price gap, but it's actually not when you switch to the day charts. Let's take a look real quick. So we don't really have a real gap. This is just a bearish engulfing candlestick, and this is actually predicative of another bearish day for Thursday. So if you're going to be betting on the market, you probably want to bet against the market. This is the first bearish engulfing we've had for a while. It's pretty important, and also the Dow Jones Index and all the major markets at the moment are greatly overbought. So it's pretty good for anyone who wants to take out some short positions. Now looks like a pretty good time, and we'll talk about the main situation in more detail in a second. For now, just look at how the terrorist attacks affected the Dow Jones Index and pretty much every index you can look at. SPY, QQQs, QQQs, QQQs. They all reacted well to the terrorist attacks. Don't know why, but that's what we got. Now, at the end of the day, why do we have this gap? Well, this goes back to the Fed and its raising of rates. So we got 2 people from the Fed making statements. You got Evans, who recently said that he now predicts 2 rate hikes instead of 4 this year. But he also said this right before rates were raised in December, which means that it's possible that the rates are actually going to be raised in April. You can see from here the implied probability is 14%, so it's actually quite low, but it jumped double. It was at 7% the day before yesterday. So after these comments from Evans, the rates, the probability of rates being raised seemed to go up, but the long-term implication is that we don't need 4 rate raises, we just need 2. Now take a look what happened. The market fell. So it fell there. It happened right, he mentioned it around there. That's when the news came out, started to fall. So we got the Brussels terrorist attack elevating the market. We got Evans from the Fed saying that we don't need 4 rate raises, and that brings down the stocks. Now I'm going to keep referring to these 4 news events that I'm going to point out so that we can look at a bunch of different aspects of the market in terms of these times. Alright, so let's review real quickly. Beginning of the market open on the 22nd is when the Brussels terrorist attacks hits the news. Then you got Evans stating that we don't need 4 rate raises, and that's at this point, at the end of this day. Now this gap comes from a third piece of news, which is from Bullard, who says April is going to be very likely for a rate raise. In other words, Evans says we don't need 4 rate raises, and Bullard pretty much says that we are going to have a rate raise soon. A little bit conflicting, but not really. However, that dropped the market. And if you remember, last time rates were raised, the market did indeed fall. Now, what is this 4th movement we see? Well, remember, there's one big movement from the Brussels terrorist attacks, one big movement from Evans, one gap movement from Bullard, and then what is this? Well, this is essentially the price of oil falling down below $40 again, and oil tends to drag stocks down. So that's what happened there. We're going to take a look. This piece of, in addition, there's a piece of news that came out that said, essentially, this freeze deal between Russia and OPEC is meaningless. I've been saying this for a while. If you freeze production, all that means is you continue producing at the same amounts, and right now they're at record highs. So you're basically freezing them at record highs. You're not capping them. A freeze and a cap are very different things. Now, another reason it's meaningless is that Saudi Arabia is the only country that has the ability to increase output. So a deal between Russia and OPEC really doesn't matter at all. And there you go. You got dropping oil prices, partly based on the news. Also, we're going to see a large increase in supply coming quite shortly. So you got oil going downward, and you could expect it's going to drag the markets downward as well. Now, if you want to take a look at oil, just look at USO, and there you go. You got oil gapping down and then dropping again at precisely that time in the market where you see that drop in the DIA. USO, DIA. Alright? Basically the same point. Now, bonds is also really important to look at. Bonds do react to the news. I'm going to look at TLT. These are 20-year Treasury bonds. Bonds react to the news, but bonds also tend to precede movements in the stock market. Bonds going up tends to predict stocks going down. Now, we had bonds going down. People were selling bonds and buying into stocks after the terrorist attacks the other day. But after the Fed stated that rates will rise, that's going to increase the yield curve, and that brings bonds to a new level. You usually don't really ever day trade these bonds, but it's actually looking pretty good with dollar movements and bond options. If you want to buy an option on TLT and just wait for a dollar increase and sell it, you can make $100 per one contract you buy. So there you go with bonds. If you want to look at the market ETFs, look at SPY, look at QQQ, you look at the Russells, IWM, they all pretty much move the same way, just to varying degrees. When small caps, like the Russell 2000, are small cap stocks. Now, small caps tends to have money flow out of them more quickly than large caps, and watching the small caps fall is often more predictive of a market correction or a market crash than is watching large caps fall. So if you look at the degree to which the small caps fell versus the large caps, here's the small caps, here's the large caps, it's very different. Small caps fell a lot more quickly and to a greater degree. The large caps, most of the falling was mainly due to that gap and oil prices being dragged down, but it found a bottom. So there you go. The two worst performers have been Energy, XLE is the ETF for trading that, and XLF, which is finance. These two fell. Finance pretty much fell consistently, which is kind of contradictory to rates being raised, because if rates are raised, you get banks making more money due to higher operating margins. Energy clearly fell, and you got SunEdison going bankrupt. You also got oil dropping, so that's definitely going to bring down these two sectors. Now, it looks like it's oversold, but ignore these because these are one-day charts. Technically, it's two-day chart, so don't pay attention to the stuff down below except for maybe volume, right? We also want to look at the VIX. This is market volatility. Some people use it as a indication of fear in investors. I really don't like to think of it like that. Just think of it as how mind-changing stocks are these days. If you see the VIX going up during a rally like we're having, we've had a bull rally for the past couple weeks now, and if the VIX goes up, it's a symbol that the rally is probably going to turn around. Now, it has gone up not to a large degree, but at the end of the day there was a big spike in VIX buying. It still didn't bring it much higher than its top. Now if you want to take a look at the dollar, you can look at the UUP. This is pretty much showing you the trend of the US dollar, strength of it. Brussels did nothing to it. Evans saying that we only need 2 rate hikes didn't really do much to it. But Bullard stating that we were probably going to have a rate hike in April brought the dollar up to a high. So it spiked the price of the dollar. And, well, if you want to compare it to other currencies, for example, the yen, you can see that the yen had been falling anyway. And now the yen is a bit up from, this is just day trading, but it's a bit up due to oil going down. So people put their money into the yen because it's a lot safer than being hedged in oil. But overall, the yen is falling. And it's not exactly one-to-one with the US dollar, as you can see. But there you go, that's the yen. You also got the British pound, which probably should have been affected by the Brussels events. So let's take a look at that. FXB gives you the British pound. Not a very liquid ETF here, but you get the picture. It fell. Now we might want to look at 3 days, but that'll screw up my chart. So we'll go look at here. So it's been falling anyway. It seems like the Brussels event didn't really hurt it that much. That's what you got there. Now, a lot of people are worried about gold and silver. Why are they falling? Take a look at the long-term picture for gold. In the past 30 days, it's remained at a relative high, but gold has been rallying. It's been rallying for a while. I think gold is a much better indicator for investors' fear than is the VIX, but gold has fallen. And gold has a lot of technical aspects to it, but probably more important than the technicals, than looking at the charts, is simply understanding how gold moves in response to different currencies and different commodities as they change. So clearly gold has fallen, and that's possibly due to a prediction of a stronger dollar or having rates raise. Those will both be catalysts to a dropping gold. After all, gold doesn't give interest, so if you have banks giving more interest, some people are going to sell their gold and move their money into banks. And if the dollar's more valuable, well, you're going to want to hold on to your dollars and probably not buy gold. Silver is acting the same way. So we had a silver rally, we had a gold rally, and they're dropping a bit. I think they're going to come back, but at the moment they're not looking that great, at least from 1 day's price movements. Now this could be a pretty good opportunity to buy a dip. If you want to buy more gold, you could do so. Note here that we have a gap though. Now what kind of gap is this? Based on the candlesticks, I would say this is an area gap and it's going to fill. So I would be long gold, not short gold. We'll talk more about gaps in another video. I'm going to make another video today, and I'll talk about some easy ways to find whether a gap is an area gap or a breakaway gap. Remember, area gaps fade or fill, and breakaway gaps widen. But what we're looking at for gold and silver is probably, I mean, it looks like an area gap. I'd have to run my algorithm on it, but it looks to me like an area gap. I don't play silver, but for me, gold is clearly different from silver, because silver had a green day prior to this day, but gold had a red candlestick prior to this day. So it's a different pattern, but gold and silver usually move together. So it's a bit confusing when you have two things that move together showing different candlesticks, but I think these are probably area gaps. Now, as for specific stocks to look at for tomorrow and probably the week coming, I would want to be short. So I'm going to recommend a bunch of short positions on individual stocks, and I'm also going to recommend some short positions on ETFs if you want to short the market. So here's Dollar Tree, which I think is a pretty good short for the moment. It's already moving downwards slowly. We have an area gap. You can't really see it, but can we do this? High is 77.37. The low is 77.51. So we do have an area gap between these two candlesticks. And I ran my algorithm on this already. That area gap is very likely to fill, and it looks like it's doing just that. So this would be a good short. Again, if you don't want a short stock, you could always buy puts. It's basically the same thing. You just got to be careful with choosing the puts. Another good one is Twitter. Twitter is now below a resistance level, and it's a very strong level of resistance. It was about 15, I think, or not 15, 17 or so, maybe 17, 16, around here. You can see that the stock has struggled around this line, but now it's broken away from this line, and it'll probably be dragged downward by momentum selling. You can see the last 2 days were mainly selling, even though we did have a green candlestick. So that's this play. If you want to get a pretty safe short, this is a safe short because the company really does suck. And you also got this bearish engulfing candlestick, which is predicative of a downward trend in the coming days. Then you got LinkedIn. Same thing, we had an area gap, but that area gap already filled. Now that it's filled, my prediction is it's going to be dragged downward. The company's management has gotten better, and in the long term, it will probably get back to its above 200 levels. If you're not familiar with that, it was trading at around 250 before this huge drop right here. So it'll probably get back somewhere in between here when management shapes up the company. But for now, I think it's going to continue downward. I mean, there's really nothing changed from when this happened. And I think still we're at a higher than reasonable level for LinkedIn. LinkedIn's a pretty good day trade. It moves a couple dollars per day. So if you buy a put option with a high delta, you can usually make 100 to 200 bucks a day if you bet in the right direction. And it looks like the right direction now is going to be downward. I've got a bearish engulfing of a doji star, and that's typically a downward trend for the next day. Then if you want to be long on, or if you want to bet on the market, you got the QQQs. QQQs, we got the first red candlestick for a long time, and it looks about the same size as the green candlestick. I'm going to say it's a bearish engulfing though. But you also got the market really overbought, and finally we have that green stochastic line dipping below the 80 level, which can act as a sell signal or a short signal. So if you want to short any market, I would go probably with the QQQs because it's at a high price, and it's very volatile. It moves faster than the SPY, so it's better for swing trades and day trading. Now SQQQ is a good way to go short on the QQQ without having to buy puts. So if you don't want to play options, just buy SQQ outright, hold on to this. It's an inverse ETF, so if the QQQ falls, if the NASDAQ market falls, SQQQ will rise. And as you can see, we're at a pretty low level, but we've been at higher levels in the past. We've been up all the way up to 30, so that's a 50% profit if we can get back up to those levels. If you want to take a look at longer time frame, you can see this has spiked many times. You'd probably not be able to sell on that day. Well, of course you could, but I mean, well, if you want to play an inverse, by the way, if you want to play an inverse on a volatile market, I'd probably go with a small cap like TZA. So TZA is the inverse of the Russell 2000 index, and it's 3 times leverage, so it moves very quickly. It's actually pretty cheap, 50 bucks. You got a bullish engulfing, so it will probably head up. It's also overbought, so we've got really good signals here that say TZA is going to head upward. This is probably a good buy and hold as you wait for the market to perhaps flatten out its problems. But overall, if you want to look at where we are in the market, you should probably be looking at the SPY in the long term, because what we're seeing now is pretty much like what we saw before, many other times before. And like I said, if you want to short this market, either short via high beta stocks, or short via puts on the QQQ, or short by holding TZA. But I'm going to show you why shorting might be a good idea, even though it looks like we're headed upward. Take a note, we don't usually see these red candlesticks at a high. The red candlesticks usually dip below the high during the process of moving upward. So let me give you an example. When the market fell in November, we made our way back up. So it stayed there for a while, and then we made our way back up. So here's the process of moving back upward. You got a bunch of green candlesticks, mainly green candlesticks, small red candlesticks. But when the red candlesticks tend to be bigger and pretty much at the high, like in this case, that's when things start going to hell. So that's when things dropped, went back up, red candlestick at the high again, things went down. Red candlestick at the high, dropped. Red candlestick at the high, dropped. And we got that same thing. We haven't seen it yet. This one, it dropped very slightly and then continued upward. But here we finally have a red candlestick at the high, matching it. In other words, we have a bearish engulfing candlestick. And we've got that, which is pretty predicative, at least in the SPY, of a top being reached. And when you have a top being reached plus a overbought market, then you have the two catalysts that can drop that market. In addition, we have a bunch of fundamental stuff, fundamental aspects on the market that just make the market look way overbought, way overpriced. Take, for example, all the earnings reports that are coming out. They are not as good as people had estimated. Revenue's down for a lot of companies. The economy's not as great as the media makes it out to be. And now is probably a good time to get in your hedges, to get in your shorts, so that if the market does correct itself, like we've seen before, why am I disconnected? If the market corrects itself like we saw before, then you stand to gain money, or at least protect your portfolio. That's it. If you like this video, please click like. Also subscribe, and I'll make more of these videos. And if you have a specific question or comment or video request, please leave it in the comment section below and I will get to it. That's it for today.